Hey, this is Ramey over at moneybyramey.com coming at you today with a new YouTube video. Today we're going to go ahead and go through the article that was just posted where we put Johnson & Johnson through our dividend analysis process, specifically the spread process that we take our dividend paying stocks through. So we'll go ahead and dive in here. As you can see on the screen, again, we have an article out here. Feel free to go out there and read it. Johnson & Johnson came up on my dividend watch list that I keep. And I review it, maybe not every day, but every other day or just when markets are down to try to see, hey, is there any stocks out there that maybe I've been watching but haven't been appealing from a valuation perspective yet. And then looking at that, Johnson & Johnson came up. They're currently, I always try to target 3% plus yield, dividend yield for my stocks. They're right around that. They're at 2.89%. But the biggest thing that drew me to them is their stock has been going down lately. And we'll get into the reasons why. But first, the reasons why I want to invest in Johnson & Johnson. I mean, they're a monstrous company. They're dividend king. It's been growing its dividends for 50 plus years. It actually has a higher debt rating from Moody's and S&P than actually the U.S. government has. So it's only one of two stocks that can say that. And to me, that's just an amazing thing that a company can be that. Some more stats: 130,000 employees, 81 billion in revenues. Been in business for a long time. Has been growing its dividend for 57 years. So that's not an easy feat. It's not easy to do. I've always wanted to own this stock. A big reason why I enjoy owning the companies that I own is because I use their products on a daily basis. I mean, if we come over here and look at some of the products that they produce, Listerine, I use that quite a bit. Band-Aids I use a lot, Clean and Clear, Tylenol. But I know a lot of these other products too are home. Everybody has them in their home, and it's one where those are the type of stocks that I want to invest in. Companies that are producing products that people use on a daily basis and continue to use those throughout the future. So that's why Johnson & Johnson was really, really appealing for me. The reason why they're trading down, and you might have already seen this, it's been in the news for a couple months here, is the opioid lawsuits. Johnson & Johnson has a little bit of exposure, or they have a lot of exposure, it's not a little, to the opioid crisis, specifically Oxycontin, however you say that, is causing some issues, a lot of addiction issues with people. It's become a big street drug. It's become something that's put people into different drugs, kind of the gateway drug, so to speak. And so a lot of companies, lawyers specifically, have been filing class action lawsuits. You might have heard of Purdue Pharmaceuticals, or Purdue Biopharma, whatever their name is. They recently declared bankruptcy because of all those lawsuits. And the reason why JNJ is trading down is because investors believe that they might have some exposure to those opioid lawsuits. In fact, they were just ordered to pay $527 million to its victims in an Oklahoma court filing, which was far less than what people were worried that Johnson & Johnson would have to pay. But it's still a good chunk of change. And the worries with Johnson & Johnson as well is that this ruling opens up the potential that they're going to be subjected to more lawsuits down the road. So that's, providing a pretty good entry point for getting into Johnson & Johnson. And there's a great piece that's out in Seeking Alpha about it. You should go out there and read it. I thought it was pretty interesting. So for me, that as a value investor, somebody that tries to be a contrarian, I saw an opportunity to come in and own a stock that I've always wanted to own, but that's been trading at too high of multiples, too high of a price point, but now is becoming more and more appealing to me as a dividend investor. So the first thing that I always do is I calculate forward dividend income, and I have the ratios out here. I invested $3,000. I was initially looking at a $5,000 price point, but basically I wanted to share. I have a resource out here on the moneybyramey.com site. If you look up here in our top right, the dividend income calculator. I don't have it under here yet, the Dividend Learning Center, but I'll get it put underneath there. But basically, this is to help anyone out there that's looking to invest in dividend stocks. I use this as a starting point where I'll come out here. I'll say I want to invest $5,000 in JNJ. Let's say their current share price, or you could have this be a target share price. is 131.65. What's their current dividend payment amount? They're at 95 cents. Dividend frequency at 4. It'll spit out all these numbers at you as far as if I wanted to invest at this price point. Here is what all my yields would be. Here's how many shares I would need to purchase. Here's the payout per year, and here's how many shares that I would accumulate. The two biggest things that I look at on here are the yield, which, again, I always want to see 3+%. I'm sometimes willing to make exceptions, and the share accumulation. Share accumulation is huge. What I want to do in my portfolio is be able to buy in at companies at certain price points that are going to yield me more and more share accumulation, with the goal of having those shares continue to accumulate, which as they accumulate, I get more and more dividend income. Now, the risk that you run with this type of investing strategy is that maybe the dividend payments become unsustainable at some point in time. So in my portfolio, I'm always watching to make sure that the stocks I'm investing in, that's not happening. But that's the end goal with this dividend calculator, is to be able to see, hey, if I do this, if I make this investment, what is going to be the end result for me. So that's really important to see and to kind of know what that is. So again, this is a free resource. You come out here and use it anytime that you want. It's in the top right hand corner. I'll get it added to my menu as well, but check it out. It's a nice handy dandy little tool. So coming back here to the article, I do like at a $3,000 share point, you don't get as much share accumulation, but you still get, close to, you get 2/3 of a share every year. So essentially every 2 years, you're getting, 1.5 about shares. So I mean, it's not amazing, but again, a chance to own J&J is pretty awesome. So the first step that I do is I go through my quick view. We're not going to go through that here today. These are just, I try to take about 10 or 15 minutes to go through these questions, answer them, looking at, Seeking Alpha, FinViz, SEC.gov. I basically try to just get really quick answers to these questions. And if I can answer yes to all of them, that's fantastic. I've invested in companies where I've been able to answer yes to 4 out of the 6, maybe even 3 out of the 6. But if I start to get too many no's to these questions, like is the company in a growing industry, if that's a no, that's going to be an issue. Because if it's in the decline, that's not going to be a company that I want to invest in. So Johnson & Johnson, in my opinion, hits on all of these points. So what we're going to get at here next is a high-level summary, and this is what I call the spread. I take all my stocks through, basically a 5-step process where it's calculating forward dividend income, quick view, the spread, and then we get in the deep dive and whether or not to buy. Right now, we're in the spread process. So this is a little bit more in depth. We're actually plugging numbers. This is where I go back to my RV single line, which I did this the other day with Johnson & Johnson. I just input their numbers in here. So this high level summary is what I actually went and copied and pasted in here. And hopefully this table is easy to read. I can always make this image too if needed, but the table just seemed easy enough to work with. But I'll kind of look at this right now. In the high-level numbers section, again, we're using the 6/30/19 6-month numbers, excuse me. The things that I really like to key in on are price to book. That's the market cap divided by the equity. That pretty much tells me how high of a valuation I'm paying for this company right now. Now, again, it's not a hard, fast rule, but I kind of reduce that down. If you divide that out, essentially, I mean, that's what I'm paying when I'm buying into the company, about 6 times equity. And I'm okay with that. Like if that gets to be like 40, 50, 60, I mean, something outrageous, then that's where I have to look at a company and be like, hey, am I buying in at too high of a multiple of the equity, which basically is the sum of the assets of the business. And then I have to, less the liabilities. And then I have to figure out, is this a company I want to buy in? So at a 6 times multiple, that's okay. Debt to equity, I typically look at anything less than 2 times. So I really like that debt to equity there. It has a negative book value. That's something I'm going to look into, which makes the debt to book value negative. So those are kind of the 3 ratios that I'm keying in off of there. And again, if there's something that sticks out that's kind of like, hey, what is that? I might look into it. Like if it was a negative working capital, I might look into that. But right now I'm not overly concerned about that. Next, we're going to get into the income statement here, which again, if we come back to our article, and I have some takeaways here where I kind of go back over what I just said. If we go to the income statement, that's on here. The biggest thing that sticks out to me on the income statement is these guys make a ton of cash, little interest expense, which tells me that companies are borrowing to them. I mean, with a AAA status rating higher than the U.S. government, borrowing to them at very low interest rates. I mean, they're making a ton of money, and that's part of the reason why sometimes I look at these opioid lawsuits. I know that lawyers are out there trying to figure out, hey, how can we get money from these companies, and that's why they're filing some of these big class action lawsuits. And so I just, in the end, I don't think that's going to be profitable for the lawyer. So what I like to do is, they're making a ton of money, and that's the reason why they're getting targeted right now. And I love, as an investor, I love to see this. This tells me that they're operating, again, with little debt or debt that is easily serviceable. The higher the EBITDA interest expense, that just tells me that A, they could take on more debt if they needed to, but B, that the current debt is sustainable as it's paid out. I mean, if this is one times, I mean, that means all net income is being paid over interest expense, and that's not a sustainable situation, in my opinion. So that's something that I really like to see. I look at this as rock solid. I mean, if I was giving this a grade, it'd be an A plus. Balance sheet is pretty solid. Coming here, they have things that I kind of key in on are down here: working capital, debt to equity. We kind of talked about this a little bit before. I like to see positive working capital. I'm going to put out pretty soon an article about my dividend criteria, the quick view, like why I like to see the things that I like to see. But essentially, if companies have negative working capital, it means that of everything that's due within a year needed to be paid with everything that is owned within a year, like liquid assets, they couldn't do it. And from what I've seen is that companies that operate like that, from a negative working capital perspective, have a bigger issue potentially having a dividend being cut because they can't service their current debt. And dividends a highly elected payment by a company. Somebody like Johnson & Johnson stakes their reputation on growing that dividend, so they prioritize for it. But companies that are maybe a little bit smaller, don't have a dividend around for as long of a time, are basically just struggling. I mean, that's one of the first things that they're going to cut. So that's important for me to see. The other thing that kind of sticks out here is the negative book value, which is basically the equity minus the intangible assets. I'm not as concerned in this case because the intangible assets, most of them for Johnson & Johnson, are made up of patents that the company owns, which, I think that there's a lot of value to that. They're making products that they have patented that people can't copy, that the marketplace really values. So to me, I'm not as concerned about that. So that's kind of what sticks out in that balance sheet section. If we come down here to the cash flow section, which again, if you're following here, again, I have some takeaways from the income statement, the balance sheet. If we come down here to the cash flow section, this company makes cash. I mean, I looked at the last 5 years, I looked at the last couple quarters. I mean, they make a ton of cash flow. And as a dividend investor, I think cash flow is the thing that we need to see the most of. I mean, income from a profit and loss statement can be easily manipulated. But when it comes to the cash flow statement, I mean, the cash in, the cash out, that's going to be a more accurate number. So that's why I put a lot more value on it. So to me, they're made $9.5 billion in cash flow. They paid out $4.2 billion in dividends. They're covering their dividends right around 2 times, which a big company like Johnson & Johnson, I think that's a pretty good ratio. The one thing we want to watch out for, if they keep issuing more shares, they're going to have to pay more dividends, obviously, or when they increase their dividend that they pay out, that's going to negatively affect how much they're paying in dividends. So that's going to be something we want to watch, but right now it's definitely adequately covered. This cash flow from financing, it's interesting that they're doing a lot of share buybacks too, which theoretically should increase the amount of amount that the share goes up, because as you buy more shares, less shares become available in the market. Therefore, those shares should become more valuable. So, I mean, net, I see a lot of positives on here. For me, it just right now it depends. Do I feel like this opioid crisis is going to be something that's going to really hurt the company, or do I feel like it's a little blip on the radar screen? And from where I'm at, I go over the spread. I really like it. I ended up deploying $3,000 worth of my capital into JNJ with the idea of buying in more into the company down the road. But I kind of like to do this thing where instead of initiating like maybe a $5,000 position, I do 3 now and then wait to see what the market does. And if I can average down, which means maybe I bought at 130, they go down to 125, I'm going to buy more at 125. That's averaging down. I mean, that's a better thing for me, and it's just a way that I use it to hedge my risk on new positions in particular. So with that being said, I added them to my portfolio. I really thought that this was a solid stock that's been trading down on news that, to be honest, I mean, I don't think it's going to have long-term lasting effects. Now, everybody has to do their own analysis. I, use this only for entertainment purposes. This isn't financial advice. So don't go out there and buy them into the stock because I bought into this stock. You got to do your own homework. But I'm hoping that, hopefully this will be some tools where it can kind of help you understand, learn a little bit more about, my process. And as always, I mean, I teach a lot on active income, passive income sources. On the passive side, I especially love dividends. I have this dividend learning center. If you click through there, I'm always adding new material to that. And if you come over here, you can live track my dividend portfolio. Currently I have 36 positions in it, with JNJ making up the newest 36 positions. I have my eye on a few different stocks coming up here in the week. I see futures are down for Monday, so it's going to be something that I'm going to be looking to buy if opportunity presents itself. But yeah, you can definitely see, dividend income trend, how this is tracking. I mean, this has been pretty beautiful. There's had one little blip down, I think, here when I think CTL might have cut their dividend. Somebody cut their dividend slightly, which sometimes some of the companies I buy, I'm okay with that, knowing that, hey, it's going to be a long-term type investment. But yeah, if you want to come over here, I've got some more great information on why I think dividend investing is so great. I also have a new book coming out pretty soon here, Simple Investing. So be on the lookout for that. If you want to buy that book, I'm going to go through my entire process, show you how I get from point A to point B, the mindset, kind of how I got involved in dividend investing. So again, that's coming out here probably in the next couple of weeks. And if you want to stay up to date, I mean, sign up for our Live Free and Div Hard email list. I promise never to spam you, never to send you garbage or sell your data. But if you come over there, you sign up for that newsletter, which obviously is taking a little while to load right now. But I promise, if you go to that link, you can easily sign up to get on our newsletter. Oh, and my internet just went out. Of course, that happens when I'm trying to load something. But definitely sign up for the newsletter. I'm hoping to help you on your journey towards financial freedom. And hopefully this analysis on Johnson & Johnson was helpful. Until then, good luck, happy investing. Please leave any notes that you might have or any comments on this article, or email me directly. I always love chatting dividends. Otherwise, I'm very active in Facebook and Reddit communities too. So again, this is Ramey over at Money by Ramey signing out. Peace.